In this video, I'm going to talk about the uncrashable Greater Toronto Area market, why I think it's not crashing, and I'm also going to show you how vulnerable we are and how little it actually takes for this market to quote unquote crash. I'm going to take a look at stats available to us, and I'm going to contextualize this in the grand scheme of things. I see headlines all the time talking about market going down, market going up, but none of it makes sense without context. So in this video, I'm going to do back of the envelope math or napkin math with the information available to me to show you what I think it would take to actually materially change the market, quote unquote, crash it. And then I'm also going to steelman the argument, and I'm going to tell you why I think that's very difficult and why it doesn't seem to be happening despite the high interest rate. So let's get into it. Hi, my name is Vassil, and I'm a real estate broker right here in the city of Toronto, where I help investors and families navigate the real estate market. Now let's get into the video and let's see whether or not this market can actually crash. Without wasting any time, let's start from our highest assumption, which is the amount of private dwellings we have in the GTA, and then we're going to work our way down to the amount of sales and how many people need to be impacted by the current rates in order for us to have a material impact of the market. Starting with the higher assumptions. In the GTA, as per Stats Canada, as of 2016, which is the latest available data, there are 2.92 million private dwellings, residential private dwellings. So that means homes that are owner-occupied or homes that have been bought by people and have been rented out. So let's call it 3 million of total residential properties that could be bought and sold in the GTA. At the exact same time in 2016, there were roughly 113 homes that were sold. So what does that mean? That means on average, we're turning over roughly 4% of the total residential housing stock on average. So if you think about it like this, if you have a street with 100 homes, you can assume that of those 100 homes, on average, 4 of those homes are going to go up for sale every single year. Now, here's the next phase. What I've noticed is that during peak years or years that are very hot, like let's say 2021 or 2016, leading up to 2017, on average, from the total listings, new listings that go on the market, in a hot year, we're going to sell roughly 65 to 75% of total listings that come on the market. However, in slow years like 2008, 2017, 2022, which was recently, we usually sell roughly 45 to 50% of total new listings. That means of all new listings that come on the market, they can be bucketed into 3 buckets. Let's start with the most obvious bucket. If in a good year, we're only selling 75% of listings, that means 25% of people that list just to test the market, but they really have no intention of selling, which kind of makes sense. So let's call it 25% of new listings that come on the market in any given year are usually just people not really serious, they're just throwing it up there, seeing what happens, but they're likely not going to sell. Now, in a good year, we know that we sell 75% of new listings, and in a bad year, we sell roughly 50% of new listings. Well, that tells me that the next 25% of people that list, they have staying power, meaning that if they get the price they want, they will sell, but if they don't actually have to sell. And that's how you go from, in a good year, up to 75% of people sell, but in a bad year, only 50% sell, because the 25% that list, they don't actually have to sell. So they're kind of testing the waters. They're serious about selling, but they will only sell if they get what they want. And that leaves us with our third bucket, which is the 50% of new listings that come on the market have to sell. Now let's go back to our example of where you have a street with 100 homes and then 4 of them are going to change hands or ownership every single year on average. That's the amount of homes that actually transacted. However, to get to those 4 homes, chances are there were 5 or 6 listings on that same street with 100 homes. It's just that, like we said, one of those was not even serious about selling. Maybe 2 of them weren't serious about selling. And then 1 or 2 were maybe opportunistic sellers. So they only sold if the market was good. So therefore, there were 4 sales because the market was good. But if the market was not good, there would have only been maybe 3 sales with a total of 6 listings on this street with 100 homes. So this is a play of how many listings come on the market and then how many are absorbed. So like I said before, in a good market, we will absorb roughly 75% of new listings, and in a not so good market, we'll absorb only 50% of new listings. If new listings doubled or even just went up 50%, that would have a material impact on the entire market. So imagine this, on this exact same street, on a normal market where you're going to get 5 to 6 listings every single year, if instead you got, let's say 10 listings, 10, 11 listings, then you will obviously have a completely different market with a lot more for sale signs and a lot more downward pressure. So what would it take to actually have 10 listings or 10% new listings relative to available inventory? that would take only 2.5% of existing homeowners to be in distress. That's right. Only 2.5% of existing homeowners that had no plans of selling their house, if they're distressed and have to list above and beyond, in addition to all the people that were planning on listing, then you have a market that now is experiencing a 50% increase in new listings, more desperation for a sale. So you're going to have probably an absorption rate of roughly 50%. However, it's going to drive prices down. So I've always known that it doesn't take much to shift market sentiment. And as you can see right here, evidenced by this example, 2.5% of all homeowners currently, that is not a lot of people to be in distress in order for us to see an influx of new listings. Now let's talk about the other side of the coin as to why this may not play out as we all think, because this market, especially the GTA market, has really changed in the last, 5 to 10 years. First, let's start with just the very basic stuff. So more than 30% of households in Canada don't have a mortgage. So there's that. So these people are insulated. From the latest numbers, I believe 2/3 of all existing mortgages right now are fixed. So really, you only have 20% of those fixed mortgages to worry about that they're coming up for renewal in the next 12 months. And then you have all the variable people, the other 1/3. So effectively, majority of homeowners are currently insulated by way of not having a mortgage or having a fixed rate mortgage that is not due in the next 12 months. Then there are the different products that banks have to extend your amortization or whatever they can do to lower your monthly payment in order not to have an influx of houses coming on the market, because obviously the banks have a vested interest in housing remaining stable. Now, from an anecdotal point of view, I want to bring you an example from 2022. I had some listings that got caught in the crossfire when obviously rates went up and prices started going down and everybody kind of went to the sidelines and nobody was transacting. I can tell you from personal experience, at that point in time, the people that were transacting were people with cash or people that were cash buyers. And this is not your typical middle-class Canadian person. So take that for what you will. I recently saw a statistic that showed that Canada is the sixth in the world destination, Toronto in particular, where high net worth individuals move. That means we're sixth in the world where we're attracting high net worth individuals to come and park their money. And guess where they park their money? Real estate. For the most part, they all have exposure to real estate in one form or another. And majority of it is concentrated here in the GTA and in Vancouver. Are we due for a real estate crash? I suppose we are, especially with rates where they are right now. However, there are all these external factors and capitalized people that are just sitting in the sidelines. They live in this country now. They're shoring up the housing market, where I just don't know whether or not we can actually crash, or at least have a material crash, let's say more than 30%, that would actually move the needle on housing. This is my hypothesis. This is my back of the envelope math. I'd love to hear your thoughts. Do you agree or do you disagree? As always, I appreciate all the feedback. And if you have any specific questions about your situation, you can feel free to reach out to me by text or email right here. And I'll see you in the next one.